Hello everyone, welcome to the latest webinar we're running. Today's webinar this morning is improving cash flow in your business. For those who don't know me, my name is George Smith. I'm the Managing Director of Cameron Computers. For any HBP customers on the call, we're the sister company for HBP down in Peterborough. My background is in accountancy before I joined Cameron, so what I'm going to do today is share a little bit of practical advice really on some of the methods and processes I've seen in other businesses, but also in our own, that have helped manage cash flow and improve processes that the knock-on effect is that our cash position's in a better place. Last week, some of you may have joined me for a webinar I did on cash flow forecasting, and that was going through the steps that are needed to build a cash flow forecast to know where you are now and where you're going to be in the future. And today is really an extension of that to say, right, if we've identified some months or weeks where we're going to have problems and cash flow is tight, what are the measures, what are the sort of the practical things we can be working on to improve that? But I think all of what I'm going to cover today is relevant of COVID-19 or not, cash flow problems or not. We all want to maximize that cash flow. We all want to make sure we've got control of it. So I think hopefully you'll be able to take away some practical advice and some useful steps here that can be put into place for the long term. Just on a bit of admin housekeeping, if anybody can't hear me at the moment, you do need speakers or headphones for this. We don't have a phone in option, and we will be recording this and sending it out afterwards. In terms of questions, please do ask any questions, but if you do them in the Q&A section, Rachel's going to keep an eye on them, and then I'll do a Q&A section at the end, so you can ask them throughout if there's something relevant, but then I'll answer those at the end. So in terms of an agenda for today, this first point is something that I did cover in the webinar last week before we went into the cash flow forecasting, but I think it's important to reflect on again, and that's the importance of cash flow. The fact that you're on this webinar indicates that you do recognise its importance, but I just want to reiterate some of those points and why it can be so important for a business. And then we're going to have a little look into the question of where is your cash right now, and some of the places you can almost look in your business and in your balance sheet to find out where your cash may be tied up. And that really leads on to the main areas I want to focus on, where more often than not we find that businesses have got cash tied up. First one of them is in sales invoicing and credit control, the fact that your cash may be in your customer base and debtors. We're going to then look at stock control. Depending on the nature of your business, these two, the importance and the value of these two in terms of your debtors and your stock can be different. For example, if you're a retailer, chances are you've got a lot more cash tied up in stock than you have in debtors, because you're probably selling most of your stock for cash. Whereas if you're a B2B business selling to other businesses, you're probably selling on credit. And so a lot of your cash may be tied up in your debtors, but for most businesses, one or both of those areas are really important from a cash flow point of view. And then we're going to have a little look at overheads, and this is one that I did touch on last week in terms of cash flow forecasting, and one of the largest areas that we see cash flowing out of a business. So what are some of the practical things we might be able to be doing, and maybe using this time at the moment if you are in any downtime, or if you have got a quiet period. It could be a really good chance to review your overheads and make some improvements that will improve your profitability and your cash flow. And then I'm just going to finish very briefly with a point on financing and just flag up some of the options that are out there that we're seeing customers use and businesses use. I'm not a financing expert by any means, but what I have got on those slides is a bit of advice and some contacts of who you may want to get in touch with to see some of the options out there and explore them further. So I'm just going to finish with the final point on financing. So going to that first point of the importance of cash flow, this is a quote that again I put up last week, but I think it's worth reiterating. Revenue is vanity, profit is sanity, cash is reality. And a lot of businesses and a lot of decision makers get the first line. They understand that revenue means very little if it's not backed up with profitability. But the difference between profit and cash can be really where businesses get caught out, and we see businesses in high growth or those that suddenly face some disruption where profits aren't always necessarily hit, but the cash doesn't keep up, and that's where it causes real problems. And as we go through this webinar, you'll see how that difference between profit and cash can really be highlighted and create problems for a business. But essentially, there's a number of things that cash flow enable us to do. Most importantly and ultimately, they allow us to meet our obligations. It allows us to pay our people, it allows us to pay our suppliers, pay HMRC or whoever it may be, and that's needed for us to be in business next month and next year. So ultimately, there's no good showing high revenues and high profits if you don't have the cash to pay your staff at the end of the month, because that's what you need to keep going. But from a more positive flip side of that as well, cash enables us to capitalize on opportunities. And if we look at the situation we're in now and what the next 6 to 12 months might look like, yes, there's going to be some huge challenges, but a lot of people I'm talking to, a lot of customers, they do feel there will be some opportunities out there. Maybe there's going to be competitors that struggle that they may be able to capitalize on. There might be new markets for them on new products. But to do any of that and to take quick action or to really make the most of any opportunities, you need cash to invest in that immediate term to return profits in the future. And then ultimately, most of us here are private limited companies, and the purpose is to generate profits to then generate distributable reserves to our shareholders. And to do that, you need cash, you need to pay them out in cash. So, you know, for a lot of SMEs, we're in business to return something to our shareholders, and cash is needed to do that. So ultimately, for me, cash is the lifeblood of the business that determines not only if we survive and meet our obligations, but also if we thrive. We're going to capitalize on these opportunities and grow as businesses. We need cash to do that, and it's one of the real common constraints or things that hold businesses back. They know what they need to do to grow more. They've got plans in place, but it's the cash they need to facilitate that. So that's just a little precursor and a little setting the scene of why I feel that cash flow is so important to a business in good times and bad. And I think this is relevant what we're going to cover, regardless of the situation now or things in a year's time or 2 years' time when things hopefully are back on the up. So where is your cash right now? Well, the place to look is on your balance sheet, and I've sort of done this as a treasure map of where you can look in your business to find out where your cash may be tied up. And on that treasure map, well, the most obvious one is in your bank, and that's great. That's the cash that we've got. That's the ultimate liquid asset that we can use to pay our obligations and capitalize on all these opportunities, like I said. But that's not going to be the only place that there's cash tied up in your business. And the three biggest ones, the most common ones that I'm going to focus on today, are your customer base. So as I said, that if you're giving credit terms, if you're invoicing on 30 days, 60 days, whatever it may be, then you're going to have cash tied up in your customer base and in your debtors. So I'm going to spend quite a lot of this session on how we manage that. It's not a bad thing, and it enables sales and it enables trade to keep moving, having credit terms. But how can we make sure those credit terms are stuck to? How can we make sure we're being proactive ourselves of collecting in our cash? And then again, depending on the nature of your business, a lot of that cash can be tied up in stock. If you're in manufacturing, if you're in retail, if you're having to purchase things in prior to sale, then there's a very good chance that you're going to have a lot of your cash tied up on your balance sheet in stock. So we're going to have a look at stock control and how we can potentially be leaner with our stock balances. That means more liquid, we've got more cash in the bank and not tied up in huge amounts of stock that we hope will sell and convert to cash one day, potentially once it's gone through the customer base and through our debtors as well. And then finally, the other place that cash may or may not be tied up in your business is in assets, whether that's machinery, whether that's IT equipment, whether that may be vehicles or plant. And that's really where I'm going to make a point around the financing at the end and some of the options people have when maybe you've already tied up a lot of cash in assets, and that doesn't mean that cash has to be tied up there forever. There are ways to release that cash, or you may be looking at making investments over the next 6 to 12 months that would need a big cash investment. There are other options out there, so I'm just going to highlight a few of them. So we're going to start with that customer base, and that's where we get into sales invoicing and credit control. So when we assess how much of our cash is tied up in it, is this a big problem? Is this the right amount of debtors for us? Have we got the right amount of our cash tied up in that? A really simple and straightforward KPI or calculation you could do is debtor days. What basically is giving you a very high level average of how long your invoices remain unpaid. So how long from you raising the invoice it takes to get that cash into your business. So if you do this at period end, if you do this at year end, for example, if you take your year end debtor value, if you take your annual sales, so debtor value divided by annual sales times 365, that will give you a number of days. Now you'll know what your credit terms are, well, probably 30 days or 60 days or something like that. And it's interesting to compare that number with your credit terms, and what you'll often find is, unfortunately, it's a large number. You can do that on a monthly basis as well. So you could do your month-end debtors divided by monthly revenue times 30, for example. It'll give you the same average, and it's by all means not an accurate, perfect calculation. You may have made a really big sale right on the last day of the month or last day of the year that throws that out, but it gives you a starting point to investigate whether you think this is potentially a problem and we're not collecting our debts in quick enough. Some statistics on this, and I was doing some research. 27% of business-to-business invoices in the UK are paid late, and 78% of us right now are waiting at least 1 month beyond our credit terms for a number of key invoices in our business. As things stood at the end of 2019, £23.4 billion was owed to SMEs in late payments, and I'm pretty confident that number will be bigger now with all the disruption we're facing. So if this isn't a problem for your business, or if there isn't any improvements to be made here, then that's great. But what these statistics show is that if you look into this, the chances are, to some degree, you're going to have some gains to be made from looking at your sales invoicing and your credit control. So that's what we're going to look at first, and do some sort of practical steps that I've seen being used either in our own business or, like I said, with clients I've worked with in different industries, that are some really good sort of general principles to follow with invoicing and credit control. So there's quite a lot of work that can be done before you even sell anything, before you even raise that invoice. So the first thing to do that often is not done is establish a clear credit control procedure, and key to this is assigning responsibilities. Now, you may have a credit controller in your business, that's great. And then it's very clear that they're responsible for chasing the invoices and following those processes, but not all businesses are large enough to justify a full-time credit controller. So often we see this is just shared about amongst the team who's most relevant to that invoice, will chase it, etc. But I think it's really important to have someone who's accountable for credit control in your business, whether that's going to be the accountant or, like I said, credit control themselves, or a key person who's responsible, and it's in their roles and responsibilities to manage the credit control process, and they're assessed on the performance of credit control in the business. And I'll touch more on the actual procedure itself, but I think this is something that should be documented. I think this is something that should be agreed with whoever is responsible, that this is how we do credit control, these are our parameters, these are our rules, and that should be set out right from the start. Next thing to do is do your research on new customers. We've all been tempted and attracted by a large deal or a large new customer, and they're playing hardball on payment terms and things like that, but please do your research. There's a lot of information out there that you can do on a customer, particularly one if you're going to be given significant credit terms. It's very easy and cheap these days to do a quick credit check online. There's websites like Credit Safe that you can subscribe to, and that will give you indications not only from a credit worthiness point of view, but it gives you access to parts of their accounts depending on the size of the business. You can even just go on Companies House website if they're and look at their latest accounts. Have a look to make sure there's no CCJs against them. Have a look to see how highly geared they are now, how much borrowing they've already got in the business. Have a look to see if they've got a cash balance. All those little things. Have a look to see how the company structured, and just make sure you're comfortable with that before progressing with any credit terms. And then when you do get to yes, I'm going to give them credit terms, agree these up front. We often see that, particularly in sales, people are concerned about raising credit terms and concerned about potentially causing a barrier in their deal or an objection in their deal. But my opinion on this is if someone's talking credit terms with you and talking payment terms, it's a buying signal. Essentially, they've bought into your product or your service, and this is just one of the objections you're going to have to tick off before they sign. And the worst thing that can happen is you get your order signed and you start ordering kit or you start putting resource into it, and then they start to question the payment terms, and you've already invested in some stock or something like that. So I'd encourage people to be upfront with their payment terms, and if there is going to be some discussion, have that before resource is committed to the opportunity, and get them agreed up front. And then finally, understand your customer's payment process best you can. So fairly common things that we see is that invoices won't be paid without a purchase order reference or without the customer's own reference. Why keep sending that invoice month after month or year after year without that purchase order reference that creates a delay in payment, creates an objection? If you know that they've got a certain process, adapt the best you can to it, because it's just going to speed things up when we get into the purchase ledger side of stuff. Also, if they've got multiple levels of authorization, if you know that it's got to be signed by a manager and then a director, we'll make sure those invoices get out there earlier and sooner rather than later to give them time to go through their processes. The likelihood is they're not going to change their entire process just for you. So try and adapt where you can, because it's only going to benefit you to speed up the procurement and payment process later down the line. So there's quite a lot you can do before a sale is done. If you're going to be on credit, just to speed up that payment and remove the barriers and the objections to payment later down the line. Once you have sold something and once you have delivered your goods or your service, there's then quite a lot of work to do that you can do that will improve the speed in which you're paid and reduce the amount of queries that ultimately is going to improve your cash flow. So the first one I think is really important is invoice quickly. If you don't invoice, you can't be paid. So we see it in our business, and I've seen it across businesses where suppliers can be shockingly slow at invoicing, and you're ultimately never going to get paid until you invoice. But not only that, invoicing quickly sets the right tone, because if you're invoicing on time, then it means that when we get to the credit control and payment on time, you've already set the tone that we do things on time, we do things professionally, and you've got to remember that delayed invoicing can be as disruptive to a business as can be delayed payments. So respect your customer supplier relationship and get your invoices out at the right time once you've delivered the service and goods, so you're not giving any excuse to hold up that process. And then with that invoicing accurately is really important. About 25–26% of late payments in the UK are down to invoicing accuracy or lack of understanding on that invoice. So we're looking at things like invoice descriptions, we're making sure our product codes, our quantities are correct, obviously the amounts are correct, that we've invoiced the right company within a group, all these sort of things. And a lot of that can be automated, a lot of that can be set up in your finance system. It can be done through back-to-back ordering and things like that. So there's loads of simple steps you can do with your own systems to mean that invoicing is accurate and quick as possible. This doesn't have to be a big manual job, but making sure it's accurate, it gives you every chance of collecting payments on time. And then clearly state your terms, not just your terms. I think invoice design is something that's often neglected, and we think of that as invoice design as quite a cosmetic thing. It really isn't. There's a lot you can do with how your invoice looks and how you display it that'll help speed up payment. We're seeing more and more customers use electronic document management and using procurement systems that do a lot of the purchase ledger reading electronically. And those electronic systems are looking for things like the terms, they're looking for your VAT registration number to link to your account, they're looking obviously for the amounts, the product codes, stuff like that. If you've got that really clear, legible and easy to follow on the invoice, then if you've got customers that use those systems, your invoice will be read automatically. It'll be put through the system. It won't be red flagged as one we can't match and that needs to be looked at manually and further delayed. So have a look at your invoice design and make sure all those key things that would be required to make a payment, your bank details, for example, all of that is really clear on the front of the invoice. And you don't have, I see things where, because of invoice designs, we've got like lines overlapping and it allows products to go off the sort of main square of the invoice. All those sort of things can cause problems. So have a look at your invoice designs and have a look at some actual invoices that you've sent out to your customers over the last few months and make sure you're happy with those designs and how they look. And then I've just got a bit of a broad one here about after sale, about maintaining a positive relationship. We'll go into the actual credit control process in a second and how that's done. But beyond that, if you think about the whole business, the way you maintain a relationship between you and your customers, that ultimately has an impact on credit control. So that comes down to our customer service, that comes down to the way we account manage our customers, that comes down to just the way we behave with our customers and suppliers is really important when it comes to credit control, because if you need to get that balance collected and there's you or someone else they can pay and you're the one that they've got a fantastic relationship with, that they get on well with, that you were understanding that last time, you're probably going to be higher up the queue than someone else. So just always acknowledge that how we behave across the business, like I said, from customer service to sales, all of that ultimately has an impact on the credit control department and how effective they can be. So always keep that in mind. And then I've done a separate slide on just some sort of general good advice and processes for credit control itself. That first one that we started right at the beginning with was, this should be a function in your business, whether if you're selling on credit and particularly if you're a business to business sales process. You may be justified hiring a credit controller depending on your size, but if you're not, like I said, still assign responsibility to someone and give them the support and training and guidance they need. Credit control is a profession. Credit control is a skill set as much as engineering or accountancy or whatever it might be. And there's lots of good methods and approaches and systems you can use, but don't just have it as, oh, you've got a spare hour, can you chase some invoices? This wants to be planned as part of someone's role. It wants to be, like I said, in their roles and responsibilities and part of their assessment criteria from a performance point of view. The second point is to be proactive. Don't leave it until things are really bad and something's 30 days overdue and you've got reds all over your debtors ledger. Just be proactive and you'll find that you don't even have to get to the latter stages of a credit control process a lot of the time. I recommend sending a polite reminder 1 week before and send a copy of the invoice. That's a really common, I won't say excuse because it can often be genuine, but a common reason for a delayed payment is we haven't got that invoice or we can't find that one. And again, the systems that you guys are using, the accountancy systems, they're either within them or with some of the plugins that we offer, you're able to automate all of this to be able to invoice and then have a reminder automatically sent out maybe 1 week before or 2 days before. You can set all this up. You're just being proactive without even creating a lot of workload for the business. So don't just leave it till things are too late. And then be consistent. I think this is really important. So don't with 1 month worth of invoicing, be pretty chilled out with it and let it get old and let them pay when they want. And then when things are a little bit tight, you're ringing them every other day and you're sending aggressive letters and things like that. That going back to that maintaining the positive relationship, that does nothing for that, and you get giving your customers mixed messages. So be consistent, and that's when I go back to having that process. So right, we all agree that we send a reminder 1 week before, we send a polite chaser a couple of days after, and then we phone them after 5 days or 7 days and try and have a conversation with them. After that, what happens if we get promised payments and they're failed, and we get to 2 weeks overdue and a month overdue and 2 months overdue? you know, you can automate if you want, or you can set up to have sort of standardized letters and processes in place before you escalate things and get things really serious. But whatever your process is, and that's for you to decide, be consistent with it and always stick to it. It's really important in giving the right messaging to customers. Query management. Now, this not necessarily, if I think about our own business, you know, we're sending out renewals and support invoices that people maybe only see once a year, so they may have queries on them to understand, you know, can you remind me again what that covers or what that might be, and we try to get our credit control team certainly up to a base level where they can answer a lot of sort of basic queries. But there does come a time, maybe we need to involve our suppliers, or maybe it needs a technical input that we need to involve with the people in our business to answer a query to get an invoice paid, and we do that, and we assign responsibility throughout our business. So if a query has gone to Tony, our operations director, he's assigned that invoice and he's assigned that task, that invoice is now with him to deal with that query, and then he'll pass it back to credit control when it's dealt with. So again, it's going back to that responsibility. Take ownership of queries and don't have them knocking around the business with no one really wanting to take ownership and the invoice just not being paid. Don't be afraid to use stop. Don't be afraid to put customers on stop. And I think this is where that consistency comes into in the proactivity. If you've been proactive and you've got a good relationship and you've given them notice and you've had multiple conversations and they've promised payment, it just hasn't turned up, as long as you're clear with that and they understand the consequences if they miss that next deadline, that they're going to go on stop, don't be afraid to use it. And like I said, it's just part of communication and part of being proactive. As long as you're consistent with it and open with it, you know, you don't have to be necessarily, you know, worried about using it. And it might be that it just speeds things up their end, or it gets an extra person involved from their business that can get things resolved for you. I think number 6 is really important. Thank customers who pay on time. Again, going back to that relationship point of view, you know, when you know that someone's had to work hard to pay one of your invoices, and you know, they've had to prioritize you over others, or you know, like I said, they've pushed it through the business for you. Build a relationship with the purchase ledger side of the business, of the customer who are doing that for you, and thank them when you know they've gone over and above to pay an invoice for you, because it will be of value next time this happens, or next time they're struggling. So it will be remembered, and it all goes back to that relationship point of view that I started with. And then, depending on the size of your business, depending on the credit control resource you've got, you may have to prioritize who you're chasing, who you're escalating, the queries that you're dealing with. So use reporting to do this. So things you can do is have a watch list of frequently late payers or frequently difficult customers who often don't pay on time. And with their invoicing, you may decide that you have a more proactive approach, and that rather than just send an email and a copy of the invoice 1 week before, you give them a phone call 1 week before to make sure they've got it, make sure they understand it, and get those queries answered even before it's due. So a watch list can be really beneficial. You know, maybe your top 10% difficult payers, and when they've got live invoices, those ones are flagged to credit control or management. And then just use your debtors ledger. Use aging on your debtors ledger, so you can most systems now you can put your invoicing into buckets, not due, 30 days overdue, 60 days, 90 days, something like that. And obviously that's a really quick way of, from a management point of view, having a look through that and saying, right, I'm going to concentrate on this balance. I can see it's 60 days and it's a couple of grand. I'm going to put my efforts into that one because that one looks at most risk to me. So use the reporting in your system to prioritize where you spend your time from a credit control point of view. So that's all the end of the sales invoicing and credit control aspect. And hopefully you can see there's quite a lot you can do that will ultimately drive down the time it takes for you to collect in your debtors, collecting your invoices. That's only going to have a positive impact on your cash flow. And hopefully you can see there, it doesn't necessarily mean you have to be massively aggressive all the time on credit control, or it certainly doesn't mean that you have to withdraw your credit terms. Credit terms are a massive sales asset and can be really useful in a sales process and allow us to grow our business and for our customers to buy off us. But there's lots you can do to make sure those terms are kept with as close as possible. Like I said, without putting the relationship you've got with your customer at jeopardy. So the second biggest area where I'm going to focus on is stock. So yes, you might have huge balances out there from a debtor's point of view, but some businesses will have huge cash balances tied up in their stock. And following the exact same principles as the debtor days, you can see how big a problem this is with the stock days calculation. So same process, but stock value divided by your purchase cost, the purchase of all that stock, times 365 will give you an annualized estimate of, on average, how long stock is sat on your shelves. In other words, how long that stock, your cash is tied up in stock. Now, this is becoming a bigger problem for SMEs and for businesses in the UK, and we are investing more and more in stock, believe it or not. And the reasons for that are first of all, this fear of selling out. The expectations of the consumer have increased all the time. The likes of Amazon with next day delivery, and we're living in a next day delivery world now, and that's moving across into the business to business world as well. That businesses, because they're ultimately consumers, are putting this pressure up on the supply chain that people want things now. People don't want to wait 6 weeks, 8 weeks for their products. They want them now. So there's a huge fear of selling out, of running out of stock, and then losing a sale, and then potentially losing a customer forever. So what we see is that UK businesses are stocking up and up and up. So the average stock days have gone up about 10% in the last 5 years, even though there's more technology out there, there's more processes out there to slicken up stock control. And we're going to touch on, there's definitely an issue here of people investing more of their cash in stock. But potentially the biggest reason we have too much cash tied up in stock is purely because of lack of stock visibility and control. We don't have a firm handle on how much stock we've got in the business, where it is, who it's earmarked for, and we end up buying twice as much as we needed, or we thought we'd run out, so we order some more in. These are really common issues. I worked with a business 2 or 3 years ago now, where their stock days figure was about 160, 170 days. So essentially about half of their revenue was tied up in stock. And the reason for that was purely because by site, they were a retailer, but site by site, they didn't have visibility of their stock once it had left the central warehouses. So they were just relying on store managers' gut feel to replenish stock, and had huge amounts of overstocking because it was all done on gut feel, and a bit of that, and they were scared of selling out of anything. They were seasonal as well, so that brought challenges into it. But what I want to concentrate on here is some really good sort of basic stock control principles that mean that if you've got a better handle on your stock, if you know exactly what you've got, where it is, and how that matches up with your potential demand, you're going to be able to be leaner with your stock control, and that will ultimately improve your cash flow. So there's a really important link there, that if we understand our stock balances better, if we know what we've got, where we've got it, we'll be able to lower our stock balance and improve our cash. So I have done entire sessions just on stock control, and I could spend an hour or two talking about this, but I've just picked out a few sort of key steps that I think can be applied to pretty much any business that manages stock, and hopefully that'll give you a starting point and something to look at. So the first one is understanding exactly what stock you've got in the business. Now, if you're using any of the finance systems we work with, you can obviously track your stock in them. But what we often see is that what people think they've got in their system, what they've actually got, over time that diverges. There's lots of reasons why. Human error, returns not handled properly, dispatches not handled properly, whatever it may be. So what we do is we do stock counts, and we do them on New Year's Eve or on our year end, and we do a big stock count to make sure it's definitely right for the start of the new financial year. and that's called a complete stock count, and that's very important and should do it. But that's often where things stop, and people do one once a year or maybe once a quarter. So they're only really getting a true snapshot of their stock very infrequently throughout the year. And the reasons for that is often just because of resource and disruption. It's very disruptive to shut down a factory or shut down a warehouse or a stock room and count everything. It requires all of our team to be working on that, not something else. So it ends up being an infrequent activity. I really recommend people look at perpetual stock counts, and basically what that is it's counting part of your stock almost on a continuous basis. So if we just had a very simple stock room with 12 aisles, rather than just count our stock room once a year and count the whole lot, we'd still do that, but we'd count one aisle once a month as well. So over the year, everything's actually being counted twice, and it does two things. It gives you complete verification of what you physically counted, what's great, so we know that's right or wrong, but it's also more of a control that it's flagging up if there's any issues, because if you start seeing large variances week in, week out of doing perpetual stock counts, you may be able to identify why you've got such big differences at the end of the year and put them right. So, you know, whether that's, like I said, a problem with your dispatching, whether unfortunately you've got some sort of theft problem or anything like that, perpetual stock counts will sort that out and flag it up. You know, I see businesses using this and doing these on a daily basis, doing random ones as well, so you don't have to do it by location. So I see people doing it by location, by product or product group, and also totally random ones. So with that random one, like I said, they're looking, it's more of a control test that they're looking to find random spot checks and problems in their stock control systems. So have a think about that, and if you could introduce that, because it gives you far more confidence on your stock value and your stock quantities, that then allows you to be leaner with your stock and free up cash. A really easy one to bring in, blind and seen count. So most common method of counting that I see when we don't have full stock control process in place is a big print out of the year-end stock ledger or stock listing from Pegasus, Sage, Checker, whatever it may be, and then hand it out to the team, and they go along and tick to make sure what the accounts package said is what they see on the shelves. Now, by saying widget A, we expect Sage says there's 50 of them, you're bringing in either at best the risk of confirmation bias, or at worst laziness, that you can have staff who just say, yeah, oh, it's about right, tick, 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 tick. But if you say, right, here's a list, widget A, I'm not telling you how many I think there are, you go and count them, then they have to go and count every single one of them. So you'll find that a blind stock count will take longer than a seen stock count when they know the expected amount, but you're guaranteed to get more accuracy, you're guaranteed to flag up more variances or issues. And that can go really nicely with the perpetual stock counts. If you're doing small accounts, doing them more frequently, you can afford to do them blind and take more time on them. So these are just a few little practical things that can be applied to your stock count processes to give you confidence over that stock valuation and that stock quantity, so you can make the decisions that potentially lower your stock balances and act a little leaner. For anyone who's from an auditing background like myself, a really valuable process that helps with the whole procurement process and your stock control is the three-way match. This is something accountants love to see because it shows really good control and process control over your stock, all your overheads and your purchasing. We call it the three-way match, and it's all about the three key documents and three key items in your purchase process and stock process all matching together and being consistent. So we start everything with a purchase order that's hopefully been approved, that's got all the right information on it, how many we want, what the product code is, what the description is, who the supplier is, etc. And then when that stock is received and we get a delivery note, at that point there should be a match between, has what we received, does that match what we ordered in terms of quantity, in terms of description, and that really should be done at receipt. So that should be done down in the stock room or the warehouse. The person receiving the stock should have access to the purchase order details. And then there needs to be guidelines and parameters about what happens if there's a variance. So what happens if they've sent more than we ordered or less than we ordered? Do we reject it? Do we accept it and send it for authorization? What we need to do is log exactly what has come into the business and been accepted. That needs to be in our systems as soon as possible, so we've got accurate stock balances as soon as possible. And then ultimately, when we get an invoice that might be a month later, might be a week later, and go to the accounts department, have they got everything they need to make sure they're paying for exactly what was ordered and exactly what was received? So all three of those documents should be matched. And again, there's a lot of automation you can do around this. There's a lot we do with customers where, for example, down in the stock room, they've got access on tablets to be able to see the purchase orders from Pegasus or Sage or Exchequer or whatever it may be able to be, and can live receipt stock into the system, and only when it matches what was actually ordered. So you've got so much more control and visibility of what's in the business, and you're not waiting potentially days or weeks for a purchase invoice to come in and then enter it into your system and update stock, by which time you may have ordered another batch because you didn't realize you had some or whatever it might be. All these small things add up to being able to have a far leaner and more controlled stock system that can mean that your cash flow is significantly improved. Not to mention that you're only paying for what you actually received and ordered, what has a very direct impact on cash flow as well. So if you think you've got this system in place, test it. Go into your accounts department and go into your warehousing and walk through this. This is something I used to always do as an auditor when I was going out to clients to assess the controls and the process they have in place. I'd do a random sample of a three-way match. So I'd pick a number of purchase orders and a number of invoices from the year, and I'd follow this all the way through, and I'd see them being authorized at the right level. I'd see the matches, and when there hadn't been a match, I want to understand what was the impact of that on the business and the system. So, give yourself a little mini audit here if you do think you've got this in place. And if you haven't got it in place, I'd really recommend you put this into the business. And like I said, there's loads that we can do to try and automate quite a lot of this for you. But if not, good old-fashioned 3 pieces of paper matched together with a signature and a staple is a starting point. Make sure all 3 match and flow through. My final point on stock control, again, depending on the nature of the business, depending on the nature of your stock, barcoding, and some of the biggest improvements I've seen in stock control process and being able to bring that stock balance down without running out of stock or without disappointing customers or pushing out lead times is by putting barcoding in place, because it's got 3 really clear benefits. A, it reduces the risk of human error when we're going back to that receiving stock in. If someone's manually typing in a product number and the quantity, etc., it works out about 1% of all manual entry has got an error in it. So for every 100 deliveries that come in, it might not always be a significant material error, but there'll be an error in 1 in 100 of those. That's throwing out your figures, that's meaning your decisions aren't quite right, etc. But if you're scanning everything in, you're removing that risk of human error. It also speeds it up. It means that you can get that information into your system as soon as possible to start making decisions on stock balances very quick. And it means you can be more ambitious, you can record more in your system. So you can start thinking about maybe batch and serial tracking. You can start thinking about bins and multiple locations within your warehouse, so you can track more information and know exactly where things are, because you can hold a lot more in a barcode than just a product and a price. You can hold things like I said, like the location, like a batch or a serial number. Asking someone to manually enter serial numbers is a very time-consuming task. It increases risk of error, etc. But if all that's barcode and automated, you can start to really slicken up your stock control a lot further. And again, all the systems we work with have got barcoding options that we can work with you with. So it is worth looking at if you think stock control is something you need to get tighter on, and potentially it could offer a really good opportunity to be leaner in the business, put more cash in the bank account and less in your warehouse or your stock rooms. So they're just 3. Like I said, I could spend an hour or so just talking about this. I'm not going to. I just wanted to flag up a few few areas of stock control that you could go and have a look at tomorrow and say, like, are we lean enough on this? Are we slick enough with where we are now? So the final two slides are all about, the first one's all about overheads. So again, when we built our cash flow forecast last week, you saw that a lot of those lines on there were actually overheads. It was things flowing out of the business. So there's loads of different reasons why cash might be flowing out of your business. But one of the most common ones that we lose control of most often is overheads, because they're not directly linked to our sales. So it doesn't always have the same control and process around it. So some of the practical things that I take away from this, if you do have time to review your processes right now, if you do have time to review your expenditure and your cash management, really have a look at your overheads. You know, report what you've been spending over the last 6 months, and let's do a full overhead audit. So things I'd look to implement sooner rather than later is budgets are really valuable. If you're going to do effective budget management and effective budget planning, be realistic with them. But it's a really good way of sort of managing by exception, of looking for variances against budget. So we expect to spend £1,000 a month on that certain type of overhead. As long as it sits around there, that's fine, it can keep going. When that goes 5% over, 10% over, that's where you spend your time and investigate. So you're making sure you're investigating by exception and prioritizing your time, rather than necessarily signing off every single invoice in the business. You're looking for the places where potential problems are. So budgets can be really, really important. That three-way match process that we covered in stock, really valuable from an overhead point of view, that you're paying and you're accepting invoices for what you've received and what you've ordered. If you've got a sound three-way match process in place, in theory, by the time things get to an invoicing point of view, there shouldn't be any queries, there shouldn't be any problems, because what you're going to sign off to pay for is exactly what was delivered, exactly what was ordered by the business and authorized right at the start of the process. So again, it's slicking things up and it gives control to your spend. Now could be a good time for a supplier review. When was the last time you looked at things like your utilities and overheads like that? When was the last time you made sure you got the best price on your gas and electric, or any sort of service like that you get? Look at your key suppliers and where you're spending the most money, and look at your spend with them over the last 3 years. Has it been consistent? Has it risen? And there's nothing wrong with it rising if there's context behind that and there's reasons why. If you've opened a new office and added an extra branch, then you'd expect certain bills to rise. But sort of just map all your overhead expenditure over a period of a couple of years, and make sure there's a story that fits with that and it's in line with your expectation. If not, understand why it does. Like I said, it doesn't mean it's necessarily wrong, but again, you're focusing your attention and your overhead review in the right areas where there could be some potential problems. And the last point on this, and this is something I've done now in business quite recently as part of our strategy planning, was profit center reporting. So within your business, you may or may not have some distinct areas of activity or revenue that could almost act as mini businesses within themselves. Often we're very good at allocating our revenue and our direct cost of sales to a product, that's fine. But what about if we can start allocating some of those overheads to the activities of the business? So in our business, you could broadly split that between IT, account software and EPOS, or I could go within account software and say, right, I've got a Pegasus department, Sage department, Exchequer department, and look at the profitability of each one of those areas, and try and assign some of the more general overheads to where they belong, and make sure every part of your business is truly contributing to your bottom line profits and covering the overheads, or its proportion of overheads in an appropriate way. So have a think about that. And again, it might need a bit of legwork. It might not be something that you can necessarily report on live, but there's certainly ways that you can make it slick and easy to do with things like cost centers and departments in your system. But I really recommend, if now's a good time to do some profit center analysis and justify each part of your business, because at a headline it might look like it's making you money, but when you start thinking about all the management effort and all the other overheads that go into it, is it really justified in your business? And that can, like I said, flag up some unnecessary overheads in the business. So my final point before we finish is on the financing. Like I said, I'm not a financing expert and don't pretend to be, but we see a lot of customers utilize financing. There's far more options out there than there was even 5 years ago, or certainly 10 years ago, away from sort of traditional bank loans that they're obviously still there. And obviously at the moment, we're seeing a number of customers being able to utilize the government-backed bounce back loans and things like that. And the feedback I've had is the process is very good and people are getting that cash into their business very quickly. So you know, that is definitely a route to think about, and it's a bit of a unique situation at the moment. But away from COVID-19, asset financing, we see this as a really common method of investing in our systems, from account software to IT and EPOS. But beyond that, we see, you know, people, whatever your assets may be that you're going to have to invest in, asset financing is in a good place at the moment in terms of from a cost point of view, and like I said, the options out there, the number of lenders out there has increased significantly over the last 5 years. So it's sort of it's a bit of a buyer's market when it comes to asset financing. The other one, again, I've seen being used well from a cash flow point of view. You know, invoice factoring and financing your invoices is available, and I have seen it being used. But there's more flexible options out there now. So you can get things like a rolling credit facility that's essentially like a big overdraft, where you don't have to pinpoint one invoice against what you want to finance. You've got a bit more fluidity that can just scale up and down as your debtors go up and down, really. So it's not for me to give any advice or suggestion on any of this, and it's all different for different businesses. But I just wanted to flag out that I see a lot of these different options being used now. We work with a guy called Rob Partridge at KC Finance, and I'd have no problem sort of recommending him from how helpful he's been and how he's worked with a lot of our customers over the last sort of 5-6 years. So I'll just put his details on there. His website's really useful for it. Like I said, it explains far better than I could a lot of the different options out there. And the message here is really that, you know, bank loans aren't the only option now when it comes to financing, and they haven't been for a long time, but they're a lot more accessible now and a lot easier to use. So definitely worth an option if you're thinking about investing in some significant amounts in kit, or if you're looking at that debtors balance, and even with credit control processes, you want to get cash maybe in the short term into the business a bit quicker. There's definitely options out there. So that's my hour up. I hope that was useful, and I tried to cover as many different areas as possible that could help with cash flow for your business, whether stock's a big issue or debtors or assets. But hopefully there's a few things people can take away from that. I don't know if there's any questions or questions, Rachel, from anyone.
No, not limited in Q&A, but just as a reminder that if you'd like a question, please post it in the Q&A and we'll answer it straight away.
Yeah, and we'll be recording. Well, this is recorded, so we'll be sharing this at the end of it. If you'd like to pass it on to questions,
George?
No?
No.
Cool. All right, then we'll end there. Thank you very much. And hope that's useful. If anybody wants to contact me directly, got a more specific question for their own business, or if like some of those processes you think, oh, we'd be interested in implementing, and where does that fit with our accounts package, or, you know, is there something that we can automate there? Speak to me or speak to your account manager, and we can absolutely help you with any of that. Thank you.
Thank you, George.
Thanks.